Well, with stocks and rates in focus today, there is no better time to welcome in our headliner today, DoubleLine CEO Jeffrey Gundlach. He joins us live now. Jeffrey, it's good to see you. It's been a while. Happy New Year.
Hey, Scott. It's nice to be with you. I can't see you, but at least I don't have an earpiece this time. It's the first time I've done one of these things without an earpiece from remote. It's actually kind of nice.
Well, let's see how it goes. It's great to have you. And as we look sort of, the last time we visited was 9 months ago. It's hard to believe it was back then in April, on April 27th. You said you thought we were going to retest the lows then and we'd take them out. We, of course, did not, and we're 71% higher on the S&P 500. So where are we now as you look at this market?
Well, we're at extraordinarily high valuations is where we are. That's being supported by massive amounts of stimulus, obviously. And one of the things that's fascinating is you go back for decades of stock market data, there are many valuation metrics that are in the top 1 percentile of overvaluation. So the thing that's keeping it going, though, of course, is the Fed. The Fed, with rates at zero and promises to stay at zero, allows for valuations to be, record-breakingly high. And that's where we are. Also, what's very important for a lot of people to understand is that many things that have been persistent trends relative to equity performance have started to reverse one after another. For example, emerging markets are outperforming the United States. Value is outperforming growth. Weak balance sheets are outperforming strong balance sheets. It goes on and on. And some of these things are getting fairly convincing. Just look at the Russell 2000 in the month of November. It had its entire year's return, basically, at least through the end of November, in that single month, up something like 16, 17%. So things are definitely changing. The leadership of the United States being the top performing market for 10 years, basically, has seemed to reverse. And the Super Six, as I've been calling them, the FANGs plus Microsoft, are no longer outperforming. So it's interesting that the generals that led the charge to one of the greatest market outperformances from the U.S. versus the rest of the world, and just an outright nominal returns space, have really left the battlefield. So a lot of things are changing, and I suspect that this is not a short-term phenomenon. Of course, the other thing that's really changed is interest rates have stopped falling. And back when we were talking back in March or April, on intraday low, the 30-year Treasury bond got to 71 basis points, and it's over 100 basis points higher than that right now. So the yield curve is steepening, the dollar is falling, the U.S. is underperforming, and these are important things for asset allocators to consider.
I mean, of course, there are those who would make an argument that big tech's underperformance is not necessarily a bad thing because you've had a widening out of breadth within the market. So whereas there was a big criticism about the top-heavy move in the market, that's widened out. Rates are still low as well, right?
Super low. Rates are really low, yes.
So do you see markets being vulnerable right here? Because the Fed's not getting out of the way, and the Fed being a principal reason of what you just said as to why we're here in the first place. If that dynamic's not going to change anytime soon, is the market vulnerable, or is it justified in being where it is?
I think all markets are vulnerable to a fact that I think is undeniable that's going to happen in the next 4 or 5 months, and that is whether it's sustainable or not, the CPI headline number is going to move up in a very meaningful way by mid-year. We have a model at DoubleLine that's worked very, very well. It's not a very complicated model, but it's amazing how well it works. And we suspect that inflation on the headline CPI is going to come up to close to 3%. It might even hit a 3 handle in the May or June report. And you might remember that Charlie Evans last week said something pretty remarkable for a Fed governor, number 2 guy at the Fed, relative to getting the inflation rate higher, which we all know is their fervent desire. He said, we're in it to win it, meaning we are in this to get inflation higher, and they don't even have to do anything based upon the base effect of how low the inflation rate was when we went into the lockdown. By the time we get to May or June, the CPI is going to be something like 3%. Maybe high 2s. But when you look at a 10-year Treasury that's barely over 1%, it's hard to believe that that level could sustain without massive intervention by the Fed if you actually had a CPI that was at that number of about 2.9 or 3%. And so I think interest rates will continue to rise until such time as the Fed decides to do their yield curve control that they've talked about repeatedly in plain English and plain sight. Where that level is the $64,000 question, because I don't think rising interest rates from this level are something that is going to sit well with, obviously not the bond market, and it's not going to sit well with the things that are at elevated valuations based upon the anchor of low interest rates produced by the Fed. So this is very important.
Yeah, so it certainly sounds like you're worried or at least concerned about the market's reaction to rising inflation. I want to read you something that Mohamed El-Arian said this morning on Squawk Box and get your reaction to it because it's right in your wheelhouse. He said, if you're looking for warning signs, I'm quoting here, if you're looking for warning signs, there are some warning signs coming out of the fixed income market. He pointed to the steepening of both the 210 and 230s. He said, quote, it's going up for the wrong reasons, not because of growth, but because of a combination of buyers getting more hesitant and people worrying about inflation. If you get another 20 basis points in another 5 to 6 trading sessions, then it's flashing yellow and a lot brighter at that point. Do you agree?
Well, I don't know about that last part. I don't know what's so magical about 20 more basis points, but let's just zoom out a little bit. We've been looking for a steeper yield curve at DoubleLine for a long time, and it's certainly been happening. I mean, 2s, 10s has been steepening. It was inverted briefly there in late 2018, early 2019, and now it's been steepening out. And I do think that inflation is a real game changer should it occur, and that certainly is why rates are rising. One thing that wasn't in that quote was looking at break-evens by comparing the TIPS market to the regular Treasury market, and the break-evens went way down, understandably, in March and April when last we spoke, because there was this economic disaster that was occurring, but the break-evens have fully recovered and are now going up. So I'm just going to reiterate, Charlie Evans said, we're in this to win it. We're in it to win it. The Fed wants inflation. One way to contextualize all this that is actually, I think, sort of the goal of the Fed is they want the inflation rate to be higher than the interest rate anywhere on the yield curve, even out to 30 years. That's one way in which you cushion the blow of this debt compounding that we're doing at shockingly high rates in response to the lockdowns. You know, the budget deficit, the real budget deficit, not the official one, if you include the off-balance sheet stuff, is 20% of GDP. I mean, we are not out of the recession. I know that a lot of people say because we've got a couple quarters of growth here, that's by some sort of dictionary definition out of the recession, but that's not the Gundlach definition. The Gundlach definition is you're out of a recession when you take out the old highs of nominal and real GDP, and we certainly haven't done that yet. So here we are running massive budget deficits, which is weakening the dollar, which will be a further impetus for inflation. And we know that the inflation rate's going up. And one thing that a lot of people really probably don't realize, if you want to win a beer at a bar with a bunch of economists, ask them what's the highest year-over-year core CPI level for the past 25 years. And most people would probably think there must have been a month in there when it was 4% or something like that, but it was never even 3%. Core CPI has been incredibly subdued for 25 years. And I believe that the big 40,000-foot overview of what's going on here is many long-term trends that we've come to trade based upon and people have baked into their forecasts and their thesis, is that a lot of these trends that have been in place are changing. And I think that inflation could very well ultimately break out to the upside. And that would be a massive game changer for everything. It would probably break apart the lack of correlation between stocks and bonds. My friend Jim Bianco talks about this. We had a discussion on my Roundtable Prime, which is up on DoubleLine.com, about this that went on for a long time. So a lot of things are changing, I think. I remember back, it seems like a long time ago now, I guess it was, Judge, we were talking back in 2017, which was the year of epic low volatility for equities and everything else, but equities in particular. And I remember when I was talking to you, I looked at the crawler, and it showed that the VIX index was at 9.85. And I said to you that my highest conviction idea was that the incredibly unprecedented low volatility of 2017 was about to change. and was about to go higher, and the VIX would go above 15 quickly. And I was derided by subsequent guests on CNBC by claiming that I didn't understand that there'd been a structural change in the world and in the VIX and in the market, and that the VIX would never, ever go above 15 again. Well, obviously, that idea that we were in a new era about the market's construction was wrong, because the VIX has been going up pretty much every year since then. And I think that the low volatility of inflation for the past 25 years is probably going to give way to something different. I respect the idea that we have so much debt that it's possible that the breakout to the CPI out of its range, its incredibly narrow range of the past 25 years, could be to deflation. That's possible under a certain construct. But I believe the Fed doesn't want that to happen. And they want the inflation rate to be above every interest rate. And another thing that's interesting right now is that average hourly earnings year over year are higher than the rate on the 30-year mortgage commitment rate. So people are actually able to borrow at essentially sort of negative interest rates, even to buy homes. And corporate bonds, for the first time in history, are actually at negative yields. And I don't believe this is a coincidence. I don't believe this is an accident. I believe this is by design. And this is one of the reasons why I think you can have a rationale for it's not insane valuations for the stock market, even though it's at nosebleed levels by historical standards. So many other things are at unprecedented situations, as I've just described.
Right. So even though you say that you know, this Charles Evans line of in it to win it, the Fed is going to be extraordinarily careful, isn't it? Is it not about letting interest rates rise too far, too fast? And this question of how much inflation and the speed and rate of it is too much. I don't know if you heard the top of my program today, but Jim Lebenthal suggested that a 10-year even getting to 1.3 to 1.5%, not that far from here, 35, 40 basis points, was going to be too much for the Fed. And they'd start putting their thumb on the scale again. They would start buying bonds to further push rates down again. Do you agree with that?
I don't know what the level is. Again, I don't have any inside information on this, and I don't even know if the Fed themselves has a preconceived notion. But they've been crystal clear that they are willing to do what they call yield curve control, which is pegging interest rates. The big question is, what level would that be? I'm going to just pull out some intuition here. I don't have any super secret information, but I think the Fed will let the 10-year go higher than 1.5. I don't know what the number is. It might be 2. But again, I'm going to go back to this theme that the inflation rate, the headline CPI, is going to go above 2.5 in the next few months. And I think as long as the viewpoint of CPI is higher than the rate on the 10-year, that the Fed may let things be. I think that if the 10-year goes above the headline CPI or the core CPI or both, that might be the trigger that the Fed comes in and does their yield curve control. Right now, that's not an issue, because the 10-year isn't close to the headline CPI, and the headline CPI is moving higher. So my guess is that fellow that you had at the top of your show, my guess is his number is a little too low as far as where the Fed will come in.
What do you anticipate a Powell Fed combined with a Yellen Treasury is going to look like, assuming, of course, that that's the dynamic and Jay Powell remains the Fed chair?
I don't buy into the narrative that's quite common that Janet Yellen is some sort of a puffball and is going to facilitate some sort of wildly easy policy. That wasn't her record as chairwoman of the Fed. She was the first to raise interest rates. She actually raised the Fed funds rate near the end of her tenure, and she voted for interest rate hikes repeatedly. And I don't think she ever voted against an interest rate hike when she was on the Fed. So I'm not, it's a interesting idea that somehow that we have, the band back together with, Joe Biden and Janet Yellen and John Kerry hanging around and all this other stuff. But I don't really think that Yellen is going to be some sort of massive facilitator based upon her record.
But don't you think that, given where we are now and the concerns about the economy, I mean, you yourself said we're still in a recession. that they're going to be extraordinarily easy, right? I mean, it's this, we're not even thinking about, and you'll probably have to add a few more thinking abouts before we get out of this range of the conversation.
Yeah, I think that's right. I mean, the Fed has been crystal clear again that they're leaving interest rates at zero for years to come. And so that's something that you could take to the bank. I mean, when Bernanke said that back in like 2010 or 2011, he was going to leave the Fed funds rate at zero for 3 years, the market didn't believe him. But they should have believed him because they stayed there for even a little bit longer. And so they're going to stay low. And this is what's creating this move up in inflation expectations, which is not trivial by any stretch of the imagination. And not just as inflation rising, but we've started to see, and I sent you a few charts, I don't know if you have them, but I sent you one that's on the food commodity prices. Agricultural commodity prices have been really depressed for a sustained period of time, just dropping and dropping, but they've started to bottom out and are now rocketing higher. Food inflation is the worst kind of inflation that there is because it hurts the poorest people who are already in a bad way based upon the lockdowns and the unemployment and the lack of wage growth, broadly speaking, over decades. And this is a real issue that has to be dealt with. Food inflation would cause real societal shakeup. And these are things, I mean, again, zooming out to the 40,000-foot overview, these are things that I've been talking about for years, that we're going through institutional teardown of the construct of society. And Judge, you mentioned that it's a good thing in a certain sense that the Super Six are no longer outperforming. And I sort of agree with that. But the extent to which they've outperformed is so massive. That's one of the reasons that we have a lot of these societal problems, is that the wealth inequality has gone from absurd to absurd squared since the lockdowns and, of course, the years leading up to it. We've gotten to the point where in the technology sector, employment is 2% of the economy in technology, and yet the stock market capitalization of technology is 38% of the market. And this is, of course, expanded very dramatically with the outperformance until recently of the Super Six. So these are things that we have to deal with. We don't like looking at them because they're not pretty, but yet you turn on the TV and you're seeing the consequences of what I've been calling the fourth turning. It's not my phrase, it's Neil Howe's phrase, Howe. He wrote a book called The Fourth Turning, which is worth reading. It speaks to how societies, deal with the disconnect between rapidly moving technology and slow, if not ossified, property relations and the institutions of society. And this is what happened.
So let me ask you this. What's your highest conviction trade right now? Now, there was, back when we spoke in the spring, you were short the S&P. I know that you just mentioned the Russell and what small caps have done and the incredible run that they've had. So let me ask you first from a equity standpoint. What is the highest conviction trade that you have on now? How are you positioned, if in any way, to reflect it from an equity standpoint?
Emerging market equities, particularly emerging market Asia, is where I would be in the equity market. I would have 25%. This is what I've been recommending for months now, and it's been working extremely well. 25% of assets in emerging market equities, particularly favoring Asia. 25% in cash, because that's a deflation position. 25%, even though I think you're going to lose money on it, in long-term government bonds, like the 30-year Treasury. That's because there's a deflation risk. And then 25% in either real estate or Bitcoin or gold or whatever you like as a real asset play. So you have 50% of your assets in deflation hedges, cash and long-term bonds, and 50% in inflation hedges, which are real assets and emerging market, particularly Asian equities. And this is a cocktail that's been working very, very well. I mean, last year, the long-term bonds helped you. They're not helping you lately, and I'm not sure they're going to, but there's enough of a risk that you need to have a fat tail asset allocation position, and that's what I'm recommending, and it's been working.
Okay, so from a fixed income standpoint, then, what's your highest conviction play?
I think bank loans are, if you have a one sector portfolio, one thing that's really interesting is bank loans had a bad year last year. They actually had a negative return, at least on a price basis. And these are floating rate assets. And it's interesting, they usually start to get some love when long-term interest rates start to rise. And long-term interest rates have started to rise. Also, there's the short-term interest rate is at 0. And so there's no chance that your interest rate is going to float lower. It can only float higher. Now, the Fed's not really giving you much support on the idea that it's about to float higher, but it can't float lower. And so I think that bank loans have had persistent outflows from a mutual fund and ETF standpoint over the past 18 months or so. And I think it's time for them to catch up. So I like that. The other areas in fixed income that are interesting are dangerous, unfortunately, because the Fed has rigged the deck, stacked the deck to the point where the things that are perceived to be okay are priced at really high levels. I mean, corporate bonds yield about the same as the 30-year Treasury in investment grade categories. High yield bonds have been priced all the way back to pre-COVID sorts of levels. So you have to go into the areas that are dangerous, which are, this commercial mortgage-backed securities market, parts of the asset-backed securities market. These are esoteric things, but retail investors can get to them via closed-end funds that invest in these types of things.
But it sounds like
go ahead.
It sounds like you're a believer in Bitcoin to certainly some extent. I mean, as a lot of brand name investors these days seem to be.
Well, I do a webcast every early January. It's called Just Markets. In fact, I'm doing it tomorrow. People can find it at DoubleLine.com. And all I do is talk about markets. I don't talk about any of my funds because we can free ourselves of the rigid compliance envelope. And last year, I said my two highest convictions ideas were the dollar was going down and Bitcoin was going up. And Bitcoin at the time was about 5,000. When Bitcoin got to about 23,000, I thought it started looking like a mania. And I went neutral on Bitcoin. And of course, it went up to 40,000. I think it dropped like 10,000 or something like today or recently. So it's volatile as all get out. But I don't like Bitcoin here. I don't like things that are up on a stilt like that. Just like I didn't like the Super 6 back in June or September. But Bitcoin to me is now in sort of bubble territory in terms of the way it's been acting. But yeah, it does have the people that point out that it has a terrific supply-demand dynamic. If indeed institutions get involved, they're right. They're right about that. And so that's what can create these massive moves up in Bitcoin. But for the time being, I've actually been neutral on gold since about the summertime, and now I'm neutral on Bitcoin. I think all of these things are kind of baked in right now, and the trade location is poor. Even the dollar, I've been very negative on the dollar since January of 2017, but I actually turned neutral on the dollar a little bit lower than where we are right now, but basically where we are right now, just because these things seem like they've gotten too deeply into the consensus narrative. A lot of people call me a contrarian. I'm not really a contrarian, but there's times when the setup, the people seem to be so much on one side of the boat that I just really don't believe the boat can sail that well. And I think that's where Bitcoin is on the bullish side right now.
It's interesting because Mark Cuban tweeted earlier today, this is a quote from his tweet, watching the cryptos trade, it's exactly in all caps, like the internet stock bubble, exactly again in all caps. I think Bitcoin, Ethereum, a few others will be analogous to those that were built during the dot-com era, survived the bubble bursting and thrived like Amazon, eBay, and Priceline. Many won't. So it sounds like you guys are symbiotic, at least to today, about where Bitcoin is and the level it is and the run that it's had.
Yeah, I haven't talked to Mark in a while. With his lockdowns, it's funny. You kind of lose track of some of the people you communicate with. But yeah, I think if you wanted to make historical comparisons of Bitcoin or the NASDAQ or relative outperformance of things back to the bubble days, there's plenty of evidence that supports that point of view. The thing that you have to be cautioned, that's a caution's warning about doing that is the Fed and the stimulus are really relentless right now. And the Fed is committed to zero interest rates for years to come. And the stimulus, I keep hearing the word trillions with an S on it in terms of stimulus. And it's sort of hard to fight the massive impetus that is created by, in the short term anyway, trillions with an S of stimulus and zero interest rates and negative mortgage rates relative to inflation and negative corporate bond real yields. I mean, these are very, very powerful impetuses. And for that reason, you can see that the bond market, it has the yield curve steepening, and we have the break evens going up pretty persistently. And for the time being, I think the trend is your friend in that regard.
Steve Weiss, you have something for Jeffrey Gundlach before we go?
I do. We've got a dual mandate here from the Fed, so we haven't talked about employment at all. Isn't that going to temper what they do in terms of raising rates anytime soon, particularly with technology continuing to pressure jobs? Yeah,
again, the Fed is not going to raise rates anytime soon. They've said so in plain sight, in plain English. And so that's not something you have to worry about. So that's why we have had this relentless rise in things. And now you have real estate rising as well. And I keep hearing commentary about how, like vaccines are some magic silver bullet and everything's going to go back to normal. There's the old nursery rhyme about Humpty Dumpty. And you can't put Humpty Dumpty back together again. And I think investors need to think very seriously about the fact that we're not going back to February of 2020. It's never going to happen. And small businesses are still closed in a huge way. I mean, about 25% of the small businesses that were up and running 12 months ago are closed right now. And one of the themes that I think is going to become apparent here in 2021 is that economic distress is going to start climbing the ladder. So what I mean by that is first hit, the baristas and stuff like that, the very low wage level. And it's going to start climbing up the ladder. What is the moment? How long does lockdown have to go on before a CEO looks in the mirror and says, maybe I have to restructure permanently the way that I'm doing business here? Because once you're locked down we're coming on a full year here. And at least here in Southern California, we don't have any visibility on when this is going to end. There comes a point when you have to say, I need to make changes into how we're operating as a business. And those changes are not hiring more people.
I know, but that's a pretty dark view on what the other side of the pandemic is going to look like. I mean, don't you think you must feel it? I mean, there's so much pent up demand. People want to get back to whatever normalcy is going to look like. Now, it may be different from what it was in February of 2020, but that doesn't mean that it's going to be the apocalypse either, forever.
I think there's a short-term pent-up demand. I think that's right. We've seen evidence of that just in the just past holiday season. If you look at the TSA data, there was a noticeable uptick versus the trend from a year ago. So sure, there was pent-up demand, and I think that happens. But I also think that a lasting effect post-pandemic is people experienced basically they had the fear of God put into them when they started to worry that they had no savings and that they were going to lose their job potentially. And I think we're going to go more into a savings economy ultimately. I mean, a lot of the stimulus money was saved. I mean, we had the weirdest.
That's true. I got less than a minute left. Just to throw that in there.
Okay, we had the weirdest snapback ever. Here was a very, very deep recession where personal disposable income actually went up thanks to the stimulus. But this is not sustainable stuff. So we're going to have a future which is going to be extremely bright, Judge, not dark. But we have to readjust, and that readjustment does take some work. So when we get through the fourth turning, it's going to be a vastly better world, I believe. But we have to go through the hard work of preparing and creating it. And I look forward to that happening.
Enjoyed our conversation. I look forward to the next. Thank you for being with us, Jeffrey Gundlach.
Thanks, Judge.
All right, we'll talk to you again soon.